Good afternoon, everyone. My name is Oman Siddiqui, and today I will be taking you through HSBC Life UK and Chesnara and how this acquisition has affected the international finance global capital market in the recent times. Let me introduce you all HSBC. HSBC was founded in Hong Kong in 1865 to support trade between Europe and Asia. Over the time, it grew into one of the world's largest banks, serving almost 41 million customers across 57 markets. This history explains by itself why selling its UK life insurance arm is a major step, not just for HSBC, but for the financial industry. Let's dive into the executive summary. In July 2025, Chesnara agreed to buy HSBC Life UK for $355 million. The deal is expected to create strong future cash flows. Chesnara is funding it through a mix of cash, loans, and new shares. The market response was calm, showing confidence. This acquisition is an important case of cross-border M&A in global finance. Let's see what happened in this case. On July 3rd, 2025, HSBC sold its life insurance business in the UK to Chesnara. This included all in force life insurance policies and investment products. Chesnara structured the deal using its own resources, debt financing, and equity issuance. The announcement was met with little market movement, which shows that the transaction was already expected in the market. Let's see why it all happened. For Chesnara, this was its biggest acquisition so far. It strengthens the company's portfolio and reduces reliance on existing markets. Importantly, Chesnara expects lifetime cash generation of more than 800 million pounds, which is over three times the purchase price of $355 million. For HSBC, this was part of simplification strategy, moving out of insurance to focus more on banking and wealth management. This is the major part of my presentation, that how this acquisition affected the global capital market. Let us discuss about the share price reaction. After Chesnara announced the $355 million deal, its share price stayed steady at 293.5 pence. This shows that investors were calm and were not surprised at all. According to the efficient market hypothesis, when information is already expected or trusted, stock prices do not change. If the market thought this was risky, we would have seen the price drop. Instead, the stability means investors had confidence in the deal. Let's focus on lifetime cash flow and the deal value. Chesnara is paying $355 million to buy HSBC Life UK, but in return, they expected more than 800 million pounds in lifetime cash flow. This is more than three times of the money they are spending. From a capital market point of view, this is a strong value assertive deal. It shows why capital market supports such mergers, because they unlock more value than the cost. Annual cash flow in the first 5 years alone, Chesnara expects to generate 140 million pounds each year from this acquisition. This steady stream of cash means Chesnara can pay more dividends to the shareholders. For investors, this is important because stable cash flow reduces risk and increase returns. This figure directly supports why the capital markets viewed the deal as a positive sign. Financing mix. The deal is not being paid with just cash. Chesnara is using three other resources: existing cash as a revolving credit facility from the banks and issuance of new shares to the investors. This shows how the global capital market system works. Banks, debt markets, and equity investors all come together to fund a large deal. Without access to these markets, Chesnara could not make such a big move. Let us see the big picture. So, looking at the number altogether, a $355 million cost expected, 800 million pounds lifetime cash flow, 140 million per year in the first 5 years, and a stable 293.5 per share. All of this proves that global capital markets made the deal possible and the investors trust Chesnara to deliver its value. Gordon growth model. The Gordon growth model links a stock value to its dividends and growth. With 140 million pound in annual cash flow from this deal, Chesnara can support higher dividends. If dividend grows, the model suggests the share price should increase. This shows how the acquisition could boost long-term shareholder values. This deal also shows synergy, the idea that the whole is worth more than the sum of the parts. Chesnara is paying $355 million but expect over 800 million pounds in return, plus 140 million pounds in an annual cash generation in the first 5 years shows strong early returns. That's a classic case of synergy in the cross-border M&A. The Trinity concept says a country cannot have a fixed exchange rate, free capital movement, and independent monetary policy all at once. The UK has free capital movement and independent policy, but a floating exchange rate. This system made it easier for Chesnara, a foreign buyer, to complete the deal without barriers. It shows how macroeconomics choice support cross-border deals. At last, I would like to conclude by saying that this $355 million deal is a strategically important for Chesnara. It created investor confidence, was supported by global capital markets, and shows the value of cross-border mergers. Using the Gordon growth model, synergy, and the Trinity concept, we can see how the deal benefits Chesnara shareholders while also fitting into the wider global finance system. These were the references I have used for my presentation. I would like to say thank you to everyone for your patience.